Welcome to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. We're here at Bloomberg headquarters in New York.
This week, happy 90th Business Week. We celebrate with a look at how the magazine has covered business through the decades.
And in the headlines this week, Boeing halting production, Carol, of that 737 MAX that's been grounded now for many months. We look at what really went wrong.
Plus, we've got more from the annual Bloomberg 50 list, our exclusive interview with Beyond Meat founder and CEO and honoree Ethan Brown.
All of that to come, but first up, this week's top political story, impeachment.
Congress will ring in the new year with stepped-up partisanship and bitter division. Sounds familiar? Well, this time it's coming in the form of the Senate's impeachment trial of President Trump. Let's get to reporter Josh Green in D.C. with more on that. The impeachment trial, big story this week. You have a fascinating story, Josh, that talks about how, with everything going on in terms of impeachment, this could benefit Joe Biden.
Yeah, it does. Look, I mean, as we in the political world look ahead to January and the beginning of the 2020 election voting and the Democratic primaries, one of the big questions everybody in Washington has is, what effect is impeachment going to have on the Democratic field? And the piece I write in BusinessWeek this week takes a look at Joe Biden and his situation. Now, one of the ironies of the impeachment trial is that it came about because President Trump thought that Joe Biden looked like he was going to be a serious rival and embarked on this dirt-digging mission with the Ukraine, essentially to try and turn up negative information on Biden. The irony is that that's led to Trump's impeachment, but it hasn't hurt Joe Biden's approval rating, at least not with Democrats. And so Biden is leading the field heading into Iowa. However, because there is going to be an impeachment trial in the Senate for some number of weeks, that is actually going to sideline 5 of Biden's Democratic contenders, who are all senators, who are going to have to spend their time on Capitol Hill, while Joe Biden can be in Iowa trying to close the deal with Iowa voters.
Josh, what about some of the other non-senators? I think about Pete Buttigieg. Does he also benefit from this?
I think he probably does. I mean, look, in Iowa, and that's really what matters here, Iowa, the caucuses are on February 3rd. There are essentially 4 frontrunners: Biden, Buttigieg, Elizabeth Warren, and Bernie Sanders. Well, we know that the 2 liberals, Sanders and Warren, are going to be stuck in an impeachment trial on Capitol Hill. That leaves Iowa wide open for Joe Biden and Pete Buttigieg. So certainly Buttigieg would rather be a non-senator than a senator. He is going to have free run of Iowa along with Biden and a handful of other candidates to try and close this deal in the weeks leading up to the caucuses.
And Josh, I do want to take you back to something you said at the top, which is this notion that this whole thing has not stuck to Joe Biden in any meaningful way, at least as far as we can tell from the polls. Does that surprise you?
It does a bit. And when I say it hasn't stuck to him, I mean among Democratic voters generally. Biden has been popular throughout, popular with key demographic groups in the Democratic electorate. And while Trump and conservatives and conservative media have hammered him relentlessly over Ukraine, that's almost made Democrats, I think, defensive about not falling for that spin, not listening to those attacks. Biden has led throughout. Now, Buttigieg recently has been leading in Iowa, but overall, Joe Biden hasn't paid a price in the Democratic electorate for these Ukraine attacks.
Josh Green in Washington, thank you so much.
Well, Washington news, among the many things our BusinessWeek team was watching this week. For more on the issue, let's bring in editor Joel Weber with this week's cover story. So, happy holidays, a lot going on.
Yep, absolutely. We put together a little holiday cover for you guys,
too. Quite a cover there talking about SoftBank. What a year.
Yeah, so we think this is like one of the biggest stories of the year, really. And it started with WeWork, which the magazine covered very early on, even during the IPO chatter when there was going to be an IPO. But as that coverage sort of developed and went on, there was another story that we started to think about, which was SoftBank.
Right.
Which was one of the biggest investors in WeWork.
I have to say, I do love the coverage, season greetings from SoftBank. But SoftBank, we did talk about it so much this year. What I love about this story, Joel, is I feel like you guys go into the layers of SoftBank, the Vision Fund, obviously the leader of it all, but there's also other players here.
Yeah, that's right. So Massar being the guy who's really the visionary at SoftBank, especially of the Vision Fund, which is this outsized force now in Silicon Valley, a $100 billion VC fund that can do a lot of things because it has so much money. And one of the ways that it can do that is go into something like WeWork and basically bankroll WeWork, which is a business model that may not have been right for the long haul yet, right?
Right. And it's funny, too, you talk about the business model, right? They were very aggressive. Like, Massar pushed his entrepreneurs.
Right? Like, let's flood the zone with money.
Big.
Go big or go home, basically, is the strategy behind SoftBank. Sometimes that works, to be fair. They have had some wins, but other times it doesn't. And the other thing that this story especially reveals is the culture within SoftBank and specifically the Vision Fund, where there's a lot of tension.
Yeah.
And not always great decisions.
It's a big story. Another big story is BusinessWeek turns 90.
Yeah, no, we're old. We're really old. It's great.
You look great for that.
Exactly.
I know, it's right. The magazine has now been around for 90 years, and we honor that with an essay that looks at how BusinessWeek has actually covered business through the decade. Sometimes we've marked moments in ways that history has not always looked back on so kindly. For instance, there's a 1979 cover about the death of equities that for a couple years afterwards it looked really good, and then, in hindsight, maybe doesn't look so good now. But it's just an amazing accomplishment that this magazine has been around this long, always being the authoritative voice on business that we've been.
Well, and I do think, and it was so interesting talking to some of the people who really put together that essay, their combined tenure at the magazine is almost 90 years in effect.
We don't go all the way back to 1929 when we first started, right actually before the crash.
Yeah.
But collectively, the people who worked on this essay can actually trace their lineage back to people that they've worked with who did work back then.
Joel Weber, thank you so much.
Thank you.
All right, well, for more on BusinessWeek's 90th and its launch back in 1929.
Someone who has spent 3 decades contributing to the magazine, that's economics editor Peter Coy.
I was with the magazine for 1/3 of its life, 30 years.
It's impressive.
I'm pretty proud of that.
Yeah.
But I was not around in 1929. So the fascinating thing is the magazine was launched in September of 1929, which history buffs will recall was just 7 weeks before the terrible stock market crash, which helped usher in the Great Depression. So not an auspicious time to be launching a magazine, but we survived those tough times and ended up thriving eventually. Huge success, and at one point had more advertising pages than any magazine in the country, and more circulation than any business magazine in the world.
And so what was the idea from the beginning?
It was McGraw-Hill was the publisher, and they bought a company called A.W. Shaw, which had a magazine called System, the magazine of business, and that was a monthly. So they spent about a year tinkering with it and relaunched it as a weekly, which was originally called The Business Week. And it was intended to be, in a way, very much like what we intend to do today, which is be a quick read for people who care about business, whether you're a business person yourself or not, but you're interested. It was, as opposed to some of the trade magazines, which were very niche, kind of vertical, it was intended to be for everyone, covering all of business.
That's what I always think is great about this magazine, because I feel like for most individuals, right, they have kind of a core thing that they're very interested in, but they're interested in the world at large. And as we have learned over the decades, increasingly, it's all interconnected.
It is. And, if you are working for a tech company, you'll be interested in the tech coverage, but you might be almost more interested in the coverage of adjacent areas because you're not following that on a day-to-day basis, and yet it will impinge on your life.
I think what's also interesting, and you guys go into it in terms of the early history in particular, about how this magazine, whether it was through some of the economists that were featured in the magazine or some of the stories, could really kind of put pressure on the government in terms of policy. It really became kind of a must-read.
I think you're referring to our early coverage of what you today call Keynesian economics. John Maynard Keynes, a British economist, was not well known in the United States. BusinessWeek was the first and most important publication that sort of championed some of his ideas. Remember, when the Depression hit, people had no idea what to do about it. The economy took an extremely steep dive. There were a lot of people who were saying, okay, let's get rid of the rot. If we can just liquidate all these people who took on foolish loans, that'll clean the system. And what Keynes said and BusinessWeek said is that, no, that's the wrong solution. That'll just spiral downward and downward and downward. The government needs to come in and support the economy with things like tax cuts and spending until it can get back on its feet. You don't put somebody who's just been in a car accident, through vigorous physical exercise.
Right.
You've got to help them recover, give them IV fluids and so on. And that was the message.
Coming up, Peter Coy will be back to tackle bubbles in this week's remarks.
You never get too much Peter Coy. And Boeing halting 737 MAX production. We'll look at what went wrong. This is Bloomberg BusinessWeek.
Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. Join us for Bloomberg BusinessWeek every day on the radio, starting at 2 p.m. Wall Street time. Also, catch up on our daily show. Listen and subscribe to our podcast. Get that at Apple Podcasts, SoundCloud, or at Bloomberg.com.
And, of course, you can find us online at BusinessWeek.com and on our mobile app. Well, a top business story, no doubt about it this week, it was Boeing.
We were watching that one closely. The company halting production of its grounded 737 MAX in January, a move that could deepen the crisis engulfing the plane maker, complicate its eventual recovery, and ripple through the U.S. economy.
It's why it's such a big story. Peter Robeson has been following Boeing for years. He explains from Seattle.
People have focused a lot about the pressure that Boeing put in its design teams to finish the plane and the way the FAA was blind to the changes because it had delegated most of the process to Boeing. What we looked at was specifically within the group of Boeing pilots. It's a group of people who test the planes and write the manuals and train customers. And what we found was that during the period when the MAX was developed, it was this group was in disarray. Many of them weren't speaking to each other because there were disputes over a plan to make more money from training customers. Training had traditionally been a service that Boeing provided, but Boeing felt it needed to turn it into a revenue generator. So there were disagreements over that. And at the time the MAX development was peaking, Boeing actually moved the simulators where it trained customers from Seattle to Miami. So it put a lot of distance between design teams that had been located pretty close together. And especially given the difficulty crews had flying the planes, we felt that looking at training was really important.
Peter, I feel like this is a big story. Jason's dad, engineer. My dad was an engineer. But this whole concept of separating the pilots from the engineers, where it used to be, Boeing kind of wrote the book on checklists and quality training and doing everything right, but part of it was that all the involved and important parties were physically near each other and constantly talking to each other.
Exactly, and that's there's a note of frustration I hear from people talking about this because they feel like it didn't used to be this way, that on planes like the 777, you had a lot of crosstalk, you had a lot of collaboration, but at the time the MAX was developed, these groups were just in different divisions, they had different managers, different motivations.
Well, and the other thing is Boeing as a company, right? Customer training used to be a service, right? It was a cost to Boeing, free to its customers. They wanted to make that actually into another revenue line, right? Another revenue source. So that was at play as well.
Right, and this actually goes back 20 years. There was a point in 1997 when Boeing formed a joint venture with a company owned by Warren Buffett, and that's when it first got the training facilities in Miami. And by all accounts, that partnership didn't work well, but Boeing continued this effort to make money from training, and its focus as all of these new pilots were coming into the industry was, we need to cut costs. The manager of the unit said, our marching orders here, given what's coming, is that we need to make training less expensive. And Boeing even introduced a point system where, to some of the instructors I talked to, they felt it created incentives for airlines not to train pilots. They felt like pilots would instead use these points on training flight attendants or maintenance technicians.
There has been so much time spent on trying to figure out what happened to these planes. There's been a lot of reporting by you and others. There's been commissions looking into it. You've had regulators looking into it. Are we any closer to actually figuring out what went wrong here?
Well, what's frustrating is that there hasn't been a public chronology of who did what when that makes it comprehensible to everyone, as happened after the Challenger explosion. But the report by international aviation authorities that was led by the former NTSB chairman came the closest, and that report concluded that Boeing simply didn't test the specific malfunction that brought down these two planes. It was a malfunction of a vane that set off this software that the pilots hadn't been told about. And ultimately that comes down to not having sat down on the simulator, talked about it, worked through potential failure scenarios.
From Boeing to the bull market, as we head into the new year and a new decade, the 2010s, safe to say, Jason, they were really good for stocks, perhaps even better than they seemed.
That bull just keeps on running. Here's this week's Business Week explainer on the longest, calmest bull market in history. Eisenhower was in the White House. TV was mostly black and white, and the baby boom was at its peak. That was the 50s, the last time stocks had a decade like the one they're wrapping up now. Stocks in the S&P 500 have returned 249% in the past 10 years. That's about 1.2 times the historical average. Not only that, the 2010s were the first decade without a bear market, a 20% drop from any peak. Still, there were plenty of moments to make investors queasy. 6 separate 10% corrections. The flash crash in May 2010, Europe's sovereign debt crisis in 2011 and 2012, and now a global trade war. But none of those killed the bull. That may be because while the perceptions of risk were high, fundamentals were stable. U.S. GDP expanded by 1.6% to 2.9% each of the last 9 years. It's expected to be in the same range in 2019. That's the smallest fluctuation over any 10-year stretch in data going back to 1930. It led to a record stretch of wins for the market. Like a kids' sports league, almost every investor took home a trophy.
Well, I think it's safe to say that we can't talk about the bull market without also talking about bubbles. Tech bubbles, a housing bubble, asset bubbles, man, we've definitely seen a few.
And someone who's seen a few himself, economics editor Peter Coy, he's back with this week's remarks. He talks about why the risky pursuits of returns amid negative rates is no laughing matter.
The economy is recovering from the worst financial crisis since the Great Depression. We've had a very long run of growth. But what? Maybe we're heading into another bubble, as evidenced by the lowest interest rates in the history of the world. You know, we're in negative territory in Europe and Japan. As far as I can tell, somebody can try to disprove me, this has never happened before.
Right.
And so what happens when rates go so low? Investors are desperate for yield, so they look for it wherever they can get it, which means they take on more risk. And that's sort of the definition of a bubble. When you ignore risks and you just make a bet that this asset price is going to go up and up and up.
Well, as you remind us that investors get, kind of stressed out when prices are down in terms of assets, and yet that's the point when there's usually opportunity versus
precisely.
when you've got valuations at higher levels.
Right now, it's holiday season,
Here he goes.
No, I'm not going to sing, but there's this attitude like, hey, times are really good.
Yeah.
Stock market is hitting new highs. Just there's a lot of jubilation in the air. Well, that's when you should be worrying, because that's when, bad loans get made in good times. And the American economist Hyman Minsky said, stability breeds instability. This is exactly when we overreach.
Coming up, we break down an often overlooked but vital corner of the global financial system. We're talking about the repo market.
This is Bloomberg Business Week. Welcome back to Bloomberg Business Week. I'm Jason Kelly.
And I'm Carol Massar. You can also listen to Bloomberg Business Week on the radio on SiriusXM Channel 119, on AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and through the Bloomberg Business app.
The repo market. It definitely makes people's eyes glaze over. Others probably turn away from you at a cocktail party, but it is a market that always seems to need to be explained, but it's an important one.
It's a really important one. We needed to make sense out of it. There was a story online this week. We called on Joe Weisenthal, markets editor, markets guru in many ways. We have him on our show just about every day. He gave us a metaphor you're going to remember. Check it out.
The repo market is essentially how various entities, whether it's a bank, whether it's a fund, hedge fund, money market fund, how they finance themselves on an overnight basis, because nobody wants to just hold cash, because cash, doesn't really earn anything. And so people always want to be maximizing their profits. So what they do when they need liquidity is they borrow it overnight, and they might pledge some collateral like treasury bonds or mortgage bonds or something like that to make the cash bills that they need to pay, so that they can make the bills they need to pay.
Right.
It feels like one of those things that no one really cares about until it stops working, which is essentially what happened in September.
Right, exactly right. So in September, we saw the rates on overnight repo borrowing absolutely soar. And it's important to recognize that prior to that, for most of the time, it moves roughly in line with where the Fed sets the rate. And it's one way, one mechanism via which the Fed sort of sets short-term interest rates, and you expect the repo market to behave. The issue is that the cash that banks have is really reserves held at the Fed. And the Fed, as part of its quantitative tightening, trying to, quote, normalize its operations post-crisis, has been reducing the available supply of cash at the Fed. At the same time, you have regulators telling banks, you have to hold a certain amount of cash as part of post-crisis regulations to ensure that you have adequate liquidity. So what we saw in September was this confluence of multiple things. There's the Fed tightening, reducing the amount of reserves available.
Right.
There's the regulatory restraint saying, no, you have to hold these reserves even though the Fed is eliminating their existence. And then you had this timing issue where, due to tax payments and treasury auctions and things like that, suddenly that created a lot of demand to
It was the end of a quarter, right?
The system. That's exactly right. So this end of quarter payments, things like that. There's another issue, which is that at quarter end and year end is when regulators come and they take a look. And the analogy that I like to use is, you might have a really messy bedroom, but if you know, like 5 minutes before your mom or dad gets home, then suddenly you clean up. So occasionally throughout the year, the regulators come peeking in, and they want to see, well, how liquid is your balance sheet? Right. What kind of assets do you hold? So everybody scrambles to hold the highest quality and most liquid assets right at the same time. The problem is, if there's a finite amount of them, then you really have to pay up to get them.
So should we expect another squeeze come the end of December? Here we're wrapping up not only a quarter, but a year.
This is a really big question. And so the man that everybody listens to on repo is this strategist at Credit Suisse, Zoltan Pozsar. Whenever he puts out a note, everybody wants to get it. They're like, what did Zoltan say? So he is concerned about this, that there's going to be this major liquidity squeeze as various entities demand this liquidity ahead of the regulators checking in at the end of the year. The flip side is that the Fed seems to be way more cognizant of the risks this time around. They've certainly stopped shrinking the supply of reserve balances, so that eases some of the strain. They've also engaged in some of these operations where people can borrow essentially liquidity at the Fed. So it's kind of unclear right now, but perhaps what we saw in September and Zoltan's warning themselves may have been what kicked regulators and the Fed into gear to present a blow. But we don't know for sure.
Coming up, we catch up with an honoree on this year's Bloomberg 50.
Going above and beyond meat. Our exclusive conversation with Beyond Meat founder and CEO Ethan Brown on the company's banner year and what's to come in 2020.
This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Still ahead, Vanilla-nomics, watching global market forces at work in the far reaches of Madagascar.
I'm glad you said that and not me. It's a great story. Plus, you've probably seen the ads, heard about their mission. We hear from the founder of Sock startup Bombas on growing the company.
Love that story. First up, though, above and beyond meat. Barclays forecasts that meat alternatives will be a $140 billion market worldwide in the next decade. So this might explain why when Beyond Meat debuted as a public company, that happened back in May, well, shares soared, making it the best IPO since the financial crisis.
It's also why the company and its CEO made BusinessWeek's Bloomberg 50 list this year. Here's our exclusive chat with Ethan Brown. He joined us from Los Angeles, talked about what surprised him in 2019.
It always is around continuing to educate not only the consumer but the media around just how healthy and how much our company is driven by the human health imperative. If you look at the products we're creating, take the Dunkin' sausage, for example. That product has 50% less fat, it has 44% less saturated fat, it's 37% less sodium, and it has more protein and more iron. So when you're beginning with a blank canvas and you're able to build a piece of meat directly from plants, you can leave out a lot of the things that you wouldn't want to be consuming on a daily basis, such as cholesterol, and you can lower things like saturated fat, and you can provide the consumer with a very healthy product that they get to enjoy, yet continue to move the ball forward year over year and making the products healthier and healthier. So as we get into 2020, you'll see us continue to drive toward goals that will enable the consumer to eat what they love, but do it in a way that's healthier for them.
Do you guys think about doing some kind of reformulating to lower calories or a lower sodium amount? Is that kind of in the future?
So if you look at the DNA of the company, we are an innovation-driven company. We produce all of our products here in the U.S., and we have our innovation center here in Los Angeles. We call that innovation center the Manhattan Beach Project. We do that because we're near Manhattan Beach, but more importantly, we wanted to evoke that sense of urgency and scale that occurred in the Second World War with the Manhattan Project itself. We brought together the very best scientists, the best engineers, the best managers, and gave them a clear goal, which is to build meat directly from plants. Now, when you're doing that, you're always improving. And we have these parameters, we call them fat, flavor, aroma, appearance, and texture, where we're constantly driving toward making the products better in each area. And nutrition would, of course, be part of that. But it's also about marketing and helping people understand the products. So if you look at the Beyond Burger, for example, that has 16% daily value of sodium, not 60, but 16%, which is well within reason for many, many meals that folks will consume, such as 2 flour tortillas or half a cup of marinara sauce, et cetera. So a lot of it is just separating the misinformation and hype from reality. This product is an extremely healthy product. It's one that I consume almost daily. It's something I feel very good about giving to my own children. And so it's really about let's educate consumers about the health of our products and about the process. We're very proud of our process. If you look at how we produce meat from plants, instead of running a lot of plant material through animals and the antibiotics that go with that, or the hormones depending on the species, the veterinary drugs, et cetera, what we're doing is taking that protein directly from the plant. We're running it through heating, cooling, and pressure, and that resets the bonds so that they take on that fibrous texture of muscle. That's it. For me, that's a much better process and one that we can be proud of. And we offer complete transparency. You'd be welcome to come to our facilities, knock on the door, and we give you a tour. People should be able to see where and how their food is made, and we believe very strong in that principle.
Walk us through the process of assessing these partnerships. You know, you name-checked some of the best known when it comes to, fast food. You've also got some partnerships in casual dining. How does that work? Because, pun intended, it feels like everybody wants a piece of this market right now.
Right. So you always want to align yourself with the marquee players, and that's what we've done from the beginning of the company. So when we decided to go into retail way back in 2009, the first company we called was Whole Foods, and then we've been able to proliferate out through Kroger, et cetera. But when you look at our venture history, the first venture firm we worked with was Kleiner Perkins, and now we have a great list, including Great Point Ventures and many others. But if you're now looking at the fast food space or the quick serve restaurant space, you also want to adopt the same philosophy. Who are the marquee players, and how do you become of service to them? And that's what we've been able to do, whether it's McDonald's, whether it's Subway, whether it's KFC or Dunkin'. We're constantly looking, Carl's Jr., Hardee's, et cetera. We're constantly looking to serve the very best partners in the space so that we can grow with them.
What's the focus? Is it retail or food service, or will it be a 50-50 split going forward?
Our focus is entirely on the consumer. It's our relationship with the consumer that makes the business so special. We listen to what they say. They told us no GMOs. They told us nothing artificial. They said keep everything natural, so that's what we do. And that makes it harder, by the way. It would be much easier to genetically modify plant material to make it take on the texture and appearance and aroma of animal protein,
Right.
but we won't do that. And so we're constantly focused on what the consumer wants. We'll meet the consumer where they are. So if it's quick serve restaurants, we'll be there for them. If it's retail, we'll be for them. Right now it's about 50-50, and the market will tell us which direction to go in.
Okay, so it could change going forward.
Yeah.
All right.
And
sure.
so, Ethan, when you think about the test, let's just talk about McDonald's for a second. What have you learned so far? Because obviously that's from a volume perspective, but also from a brand perspective, something that everyone, investors included, have been looking at very closely. What have you taken away from that test?
So I had the great privilege of being up in the Ontario area a couple weeks ago, and I drove out to McDonald's there, and I went to 3 different stores and had the burger at each location, and they were identical and delicious. It was a fantastic experience for me, and one that was very satisfying. It's a goal I've had for a very long time, to be of service to McDonald's. It's going very well. I think you heard the CEO of McDonald's Canada say that. We can't comment further than what they've said publicly, but I'm very enthusiastic about that relationship and our ability to grow the partnership.
Does it expand then to the United States?
That's up to them, but what you want is a great test, and I think we have every sign that that's the case.
China accounts for about 27% of the world's meat consumption by volume. They already eat a lot of plant proteins, and they kind of look at meat as a bit of a status symbol there. What's your approach? What's your expectations for China?
You'll see us be very aggressive there. We are aggressive in each market that we occupy, whether here in the United States, mentioning again those partnerships, McDonald's, KFC, Dunkin', Subway, et cetera. You'll see us move with speed and exploit the first mover advantage we have globally in terms of building the brand that's most closely associated with the plant-based meat movement. So I can't disclose anything particular, but you can guess that we're very excited about that market and very active in our plans.
All right, let's talk a little bit about chicken, if we can. Big chicken fans here as well.
I'm kind of hungry, I'm just going to tell you.
Seriously. I mean, the KFC test, as it were, down in Atlanta, I believe, is where that was. Yeah. It went gangbusters. How soon can you sort of get into that market in a meaningful way?
So you'll see some exciting things from us in the poultry space in 2020. I can't name specific partners or developments, but we look at 3 core platforms. We have beef, pork, and poultry. And you can see consumers pulling off very quickly of beef and pork. And you're also starting to see some pressure around the poultry industry. So we've done a lot of work there. You'll see the fruits of that in 2020.
I do wonder what you've learned along this very interesting year as a CEO and as a leader of a company that really is about a lifestyle and sort of who we are.
So to get up every day and be able to go into an office and work on issues that are so important, not only to me personally, but to the world, is a privilege. And so this year, I think we were recognized by the markets for what we're doing. And we don't believe that this is a short-lived trend. This is something that has very long legs to it. If you think about what we're doing, we're not suggesting that people don't eat meat. We think that'd be a big mistake. I grew up eating meat. I love meat. I love fried chicken. I love burgers. The idea behind the company is to provide a better form of meat, right? To provide meat that provides all of the delicious, satiating experience that we've come to love, but does so in a way that's healthy for your bodies and healthier for the earth. If you look at what the mobile phone did in relation to the landline, nobody had to denigrate the landline. And we don't think we have to denigrate animal protein. We simply have to provide the consumer with a new and better choice and let them make the decision. And if we're successful, more and more will sign on with us.
Coming up, the wild economics of vanilla.
It is pretty wild. Plus, Dubai to Saudi Arabia. It's only a 2-hour flight, but it turns out it's one of the most profitable routes for the world's largest international airline.
That's all coming up. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Jason Kelly.
And I'm Carol Massar. Join Bloomberg BusinessWeek every day on the radio starting at 2 p.m. Wall Street time. You can also catch up on our daily show by listening to our podcast at Apple Podcasts, SoundCloud, and at Bloomberg.com.
And of course, you can find us online at businessweek.com and through our mobile app. So, Carol, you pointed this out when we were doing this story. This is the type of piece that BusinessWeek does so well. It takes something that many of us take for granted, in this case, something that's in all of our kitchens. We're talking about vanilla. It goes really deep and explains the wild market economics.
And speaking of wild, Jason, it required quite a wild trip to actually get this story done. Here's reporter Monty Reel in Chicago with his adventure. It was an adventure in Madagascar.
This is a regional market. This is the place where vanilla actually enters the international marketplace. And it's really remote. It's really kind of hard to get to. It's basically a hut, a wooden hut in a really small village in northeastern Madagascar, which is the vanilla growing region. And just to give you an idea of how tough it is to get there, so you fly to Madagascar's capital, you take a small plane to a small airport in the northeast. Then you have to drive over really, really bad roads to try to get to this particular market area. And for example, when we did that, our driver couldn't go any further because the road we were on was actually swallowed by a river. So we had to wade across the river. Luckily, it wasn't very deep. And then walk for a couple hours beyond that to finally reach this little hut, really, in a village where dozens of farmers would bring their annual harvest of vanilla, and that's where it would be bartered over by international flavor companies and exporters, and then go out into the wider world.
I gotta say, there's a great line in your story how you talk about where you went as this great observation lab that, I want to take your words, exposes both the genius and the insanity of globalized commerce. I mean, that's exactly what you saw at work.
Yes, it's almost hard to imagine some of the things that happen in the vanilla trade in terms of, for example, just how the crop is paid for. It's all cash. It's a cash economy. So the buyers who go to these markets have to get cash, along the same route that we took to get there. And the biggest denomination bill in Madagascar is worth about $5. And these buyers are buying tons of vanilla beans, and these vanilla beans can, when they're cured, can cost as much as $600 per kilo. So they need lots of cash. So they bring bales and bales of cash to these markets on the back of motorcycles and just being carried. And that's just one example of kind of the strange market that vanilla is because of its isolation there in Madagascar, and also because of the price swings.
And so, Monty, I have to say, reading this story, and Carol and I have talked a lot about it this week, just between the two of us at our desk, this notion of how is this market so limited to this one really obscure place? Because this is not one of these things that candidly you read about in the back of Pursuits where, only people who are billionaires can get this. I mean, this is something we both have in our homes. How has it been so limited to this one geography?
Well, it comes from an orchid. Vanilla grows from the flower of an orchid, and it's actually native to Mexico. But many years ago, it was basically transferred to Africa, and it was found that it grew very well in Madagascar. And just, vanilla is not one of those products that can be grown like soybeans or something like that, an easily managed commodity. It really is a stubborn crop, as people who grow it describe it. It likes to grow among other plants, and it's incredibly labor intensive. So every step of the growing and cultivation process is done by hand. Even the pollination of the flowers to get the beans to grow is done by hand. So it comes down to one of the main reasons why Madagascar dominates the trade so much is labor costs. The minimum wage in Madagascar for agricultural workers is about 18 cents an hour. So, in talking with people who work for vanilla companies, they talk about trying to grow, start plantations in other tropical areas like places like Indonesia. There are countries in Africa that have started to develop a vanilla industry. But they say that, that works well when vanilla prices are at highs. But whenever the prices tank, it becomes financially unstable to invest in those kind of operations.
Well, from a long trip in search of vanilla, quite an adventure, to a much shorter pedestrian trip that has helped build Emirates into the world's largest international airline.
It's a story in this week's business section on one of its most profitable routes and how the airline got there. Here's the editor of the business section, Jim Ellis.
Emirates, which a lot of people thought won't make it simply because it's got this hub out in the middle of the desert and who wants to fly there? Well, they've become the largest international airline, and they have basically become a connecting point for long-haul traffic from around the world. I mean, it makes a lot of sense because of the placement of the Gulf region. A lot of traffic from Asia, Australia, whatever, can connect to things from North America and Northern Europe, and it's become this mega hub, and people think of it as the airline for long-haul traffic.
Right.
However, what's really interesting about this story and what was so much fun about it is that it turns out that one of Emirates' most profitable routes is a short 2-hour flight from Dubai to Riyadh, which is the capital of Saudi Arabia. And it's because of some truisms about business that the Saudis don't like, but a lot of people who want to work in Saudi Arabia don't want to live in Saudi Arabia, particularly all of the time. There's no alcohol. There's a lot of restrictions on women. There's a lot of restrictions on life that is the exact opposite of Dubai, which is sort of the freewheeling sort of fun spot of the Middle East. It is a place where lots of people from outside the region want to live and would love to be based. A lot of them have moved there, and as Dubai's growth has sort of slowed, more and more of them are having to look for work elsewhere in the Middle East. And so a lot of them go to Saudi Arabia because the government has a lot of projects that need outside consultants, a lot of outside expertise. And Saudi Arabia is actually responsible for half of all of the consulting revenue business in the Middle East.
That is amazing.
It is, it's a small country, even though it's an extremely rich country, and it needs a lot of people, everything from education to people to help with their energy business, to people help with their diversification away from the energy economy. And so they bring in a lot of people for that, but a sort of cottage industry is broken out for people who will live in Dubai on the weekends and work in Saudi Arabia during the week.
Coming up, Bombas. Many have heard of it. It's a sock brand with a mission, helping those in need.
Love that mission. We sat down with its founder, David Heath. This is Bloomberg BusinessWeek. Welcome back to Bloomberg BusinessWeek. I'm Carol Massar.
And I'm Jason Kelly. You can also listen to us on the radio on Sirius XM Channel 119, also AM 1130 in New York, 106.1 in Boston, 99.1 FM in Washington, D.C.
AM 960 in the Bay Area, in London on DAB Digital, and of course always on the Bloomberg Business app.
Well, the direct-to-consumer sock company Bombas, it started back in 2013 as a way to help the homeless. For every pair of socks they sell, they donate a pair to those in need.
It's a great mission, and listen to this. They've done it at a profit and with impressive growth. We caught up with founder David Heath.
From day one, we were always just focused on positive ROI in terms of customer acquisition. I think one of the things that really separates us from a lot of our peers is that, in total to date, we've only raised $4 million of capital, while a lot of our peers have raised $50, $100, $150 million with these crazy valuations. But you peek behind the curtain and none of them are generating any money because they're chasing this lifetime value per cost per acquisition ratio. We kind of went back to the fundamentals. We were like, consumer businesses have been around for almost 100 years now. And the way that consumer businesses work is you buy a product for Y, you sell it for X, and you run the company off of the margin.
Right.
And so we're like, why does direct to consumer have to be any different? So we really bucked a lot of the trend there, and we've been profitable every single year.
You have been.
That we've been in business, except for year 2, which was a big kind of growth capital year for us.
What's your sales growth rate?
Been 100% year over year. Some years, close to 200 to 300%.
And you're like at 100 or 200 million in sales. Did I see?
Just about. Yeah.
And so talk to us about the customer. I mean, I'm a customer, and it's interesting because I've both bought socks and then, they've been giveaways at a conference or whatever.
Yeah.
It is a great gift. Like, Who is the typical customer, if you can generalize?
There isn't really just one. I mean, we actually, what we've been super surprised about is that we have super broad demographics. And I think that's to the point, right? Socks are an item that every single person wears. Yeah. Whether you're 2 years old or 92 years old, you're probably wearing socks at some point, in your year, even if you live in warm weather climates. And I think the idea that, we've produced something that stands out in the marketplace, it's super comfortable. Comfort is not unique to, millennials or Gen Xers or boomers, right? Everybody wants to feel comfort. And so, we've got just as many customers who are, 25 to 35 as we do customers who are 65 to 75 and older. Same thing with demographics in terms of, spends. We have 25% of our customers earn under $50,000 a year and 25% earn over $150,000 a year. And so we see it as somewhat of an affordable luxury, right? One of the benchmarks that we've always used was Starbucks, right? We took a commodity type product, improved upon it, provided a really good customer experience and a great brand. And all of a sudden you can see how a customer who used to spend $20 a year on socks could spend $60 a year on socks. It's not the $40 delta, is not the difference between them, paying their mortgage or not, where you can't do that with something like a car, right? And so I think because it's an affordable luxury and because we have the mission and because our product stands out so much in the marketplace, it attracts a large group of customers.
Well, and I also do think about something we've talked a lot about, that people are thinking about, let me do something, let me pay some, I'll pay up for quality, right? And something that's going to last, but that also is giving back and doing good and not maybe impacting the environment as much. And we are slowly maybe seeing a lot more of that happening in retail. I think about Fashionopolis, right? And, kind of the waste in the retail industry so that people are starting to kind of filter through.
Yep.
And you're seeing that play out.
Totally. Yeah. I mean, again, we're living in a social media age, right?
Yeah.
Where information is king and no longer can you hide bad company values, behind a closed door, right? All of this stuff, whether it's Glassdoor with your employees or, social media where the customer is going to post whether they had a good experience or a bad experience on any one of your social posts or one of your ads. So you've got it. The benchmark and the standards by which you have to live are so high, but it's great because it makes everybody responsible, right? Because the lens and the voice has moved, the power has shifted back to the consumer where, it used to be, but there was always kind of a delay and you could kind of cover it up for a while. But now this day and age, information is flowing rampantly. So you can't hide behind these things. I mean, you look at some of these companies and you look at the WeWorks or even Away, which just happened, you can't prop up a company on, bad actions. It will eventually suss out. So you've got to play by the rules.
Bloomberg BusinessWeek is available on newsstands now.
And also online at businessweek.com and on our mobile app, where you can find more stories, including this week's cover on the tension-filled world of SoftBank's Masayoshi-san. All right, Jason, what's your must-read?
It's one of the shorter stories, but I think it really packs a punch. It's the story about Emirates. I love that
You've been
airline.
talking about it all week.
Yeah, and it's a story that tells the story of this route, but also the economics of the region. I loved it.
Okay, my must-read was the story that Monty Reel did about vanilla
incredible.
going to Madagascar. The trip alone was really difficult, but he really got into how does vanilla basically get to stores here, into our pantries. It's a complicated story. It really tells the story of, I feel like, global trade.
Yeah, and not such a rare element. It's in everybody's pantry, and yet, wow, what a market.
I love that story. Check out, though, our Daily Business Week podcast as well. That's available at Apple Podcasts, SoundCloud, Bloomberg.com, wherever you get your podcasts.
This week, our whole conversation with the CEO of Beyond Meat. More Bloomberg Television starts right now.